They laughed before he even reached slide 3. Not loud enough to be rude, but loud enough to be remembered. It was the kind of laugh that hides behind polished manners, the controlled chuckle of men who believed they were untouchable. The boardroom was wrapped in glass and steel, 30 floors above a city that pulsed with money. Every chair around the table cost more than his monthly rent. Every watch in the room probably cost more than his car. And yet, he was the only one who had actually studied the numbers correctly. He wasn't nervous. He was aware that he didn't belong in their world. No Ivy League degree, no family office backing him, no billion-dollar fund logo stitched onto his confidence. Just research, pattern recognition, and a warning. "You're overexposed," he said calmly, clicking to the next slide. One of them smirked. Another checked his phone. A third leaned back in his chair and folded his arms. "Markets are strong," someone replied. "Liquidity is abundant." He nodded slowly. "That's exactly why it's dangerous." Silence. Then the laugh. "You're assuming a correction." "I'm assuming fragility," he corrected. They dismissed the difference. That was their first mistake. He left that room knowing two things. They were powerful, and they were vulnerable. Most people mistake scale for strength. He didn't. He saw leverage ratios hidden under optimism, short-term debt disguised as aggressive growth, portfolio overlap masked by marketing language. He saw what they refused to see, and he made a decision that day. If they wouldn't listen, he would prepare. He didn't try to compete immediately. He studied. For 18 months, he disappeared from their radar. No social media presence, no flashy startup announcements, no panels. He built a small private investment structure with strict internal laws. No dependency on short-term capital, minimal liquidity reserves at all times, no investment without downside modeling under recession scenarios, control over minority ownership whenever possible. Friends told him he was too cautious. Advisors told him growth required aggression. But aggression without insulation is gambling, and he wasn't gambling anymore. Because this wasn't his first failure. Years earlier, he had built a promising venture that collapsed in 6 months when credit markets tightened. He had trusted momentum over margin of safety. He paid for that lesson personally. This time, he would build differently. The correction came quietly. Interest rates ticked upward, credit tightened slightly, then more. Tech valuations wobbled, speculative funds requested emergency capital. It didn't look like disaster, not yet, but it looked like stress, and stress reveals structural weakness. Within months, mid-sized firms started missing obligations, not because their products failed, because their financing did. Exactly what he had predicted. While large funds debated internally and hesitated, he moved. He didn't chase headlines. He approached companies with stable revenue but broken balance sheets. His offers were simple: liquidity in exchange for control, debt restructuring in exchange for equity, governance oversight in exchange for survival. Some resisted until they ran out of options. His first acquisition was small, a logistics operator suffocating under variable rate debt. Revenue steady, expenses predictable, debt toxic. He replaced short-term obligations with long-term fixed instruments, installed financial discipline, cut unnecessary expansion plans. Within a year, margins improved dramatically. He reinvested profits conservatively. Second acquisition, a manufacturing supplier squeezed by rising financing costs. He integrated procurement systems between his companies, reduced redundancy, strengthened cash flow.
Third acquisition, a mid-tier software services firm abandoned by a large fund during portfolio contraction. They weren't weak, they were inconvenient. He specialized in inconvenient strength. Meanwhile, the firm that laughed at him announced losses, then asset write-downs, then restructuring. Their overexposure to speculative assets backfired. The press called it market headwinds. He called it predictable leverage correction. He didn't celebrate. He waited, because timing matters more than emotion. When their stock dropped enough to create vulnerability, he began accumulating shares quietly through structured vehicles, not enough to trigger alarms, enough to matter. He wasn't attacking, he was positioning. Board meetings inside that firm grew tense. Investors demanded stability. Redemptions increased. Liquidity tightened. They needed capital, and he had it. The same man who once stood in their boardroom ignored, now held leverage. But power reveals character, and this was the true test. Would he humiliate them or restructure them? Negotiations began discreetly. This time he entered through the front door, invited. The room felt different. No laughter, just calculation. He presented a stabilization plan, capital injection, portfolio risk reduction, structural overhaul, board representation, strict leverage ceilings. They didn't like the loss of autonomy, but autonomy without liquidity is illusion. They agreed. The deal closed. He didn't dismantle the company, he disciplined it. Speculative divisions were reduced, risk oversight expanded, liquidity buffers mandated. Within 18 months, the firm stabilized. Within 3 years, it regained profitability, and he became majority stakeholder. The headlines framed it as a bold strategic takeover. They didn't mention the laughter, but he remembered, not with bitterness, with clarity. Because here's what he understood that most never do. Rejection is leverage in disguise. If they had accepted his proposal years ago, he would have remained dependent. Their dismissal forced independence. Independence forced discipline. Discipline built resilience. Resilience created acquisition power, and acquisition power built control. But this was only the beginning. Because once you buy one company that laughed at you, the market starts watching. And when the market watches, power attracts attention, and attention creates new enemies.
The headlines were subtle at first. Independent investor restructures struggling fund. New leadership stabilizes mid-tier asset manager. Nothing dramatic. But inside financial circles, the tone was different. People were asking questions. Who is he? Where did he come from? How did he have liquidity during contraction? More importantly, how did he move so fast? Speed during crisis is not luck, it's preparation. And preparation scares competitors. The firm he now controlled wasn't small. It had connections, long-standing relationships, political familiarity, industry presence. His acquisition didn't just shift ownership, it shifted influence, and influence disrupts hierarchy. Some executives inside the firm resisted quietly, not openly, that would be foolish, but through delay, through subtle pushback, through cultural friction. They weren't used to discipline, they were used to expansion. He didn't fight them emotionally, he replaced incentives. Bonuses tied to risk-adjusted performance. Capital allocation committees independent from growth teams. Liquidity ratios embedded into compensation formulas. Culture doesn't change through speeches, it changes through math. Within a year, internal resistance faded because discipline worked. Profits stabilized, volatility dropped, investors returned, and something unexpected happened. Smaller firms began approaching him directly, not for capital alone, for protection. They saw what he had built, a system that didn't panic during stress.
In a market addicted to speed, he offered durability. But growth creates visibility, and visibility creates competition. A rival fund, one larger than his original target, began aggressively countering his moves. Whenever he targeted a mid-sized firm, they appeared with higher offers. Whenever he negotiated restructuring, they whispered alternative financing options. It wasn't personal, it was territorial. The market had accepted him. Now it wanted to test him. He studied this rival carefully. Aggressive leverage, strong media presence, charismatic leadership, rapid expansion across trending sectors. It reminded him of something, his former self. That recognition wasn't comforting, it was instructive. Instead of bidding wars, he changed strategy. He stopped chasing visible assets. He began building infrastructure behind the scenes, payment processing rails, supply chain data systems, private credit pipelines, unsexy, invisible, essential. While competitors fought over headlines, he built plumbing, because whoever controls plumbing controls flow, and whoever controls flow controls survival. The rival fund grew quickly. Press adored them. Awards, panels, interviews, they were celebrated as visionaries. He remained quiet. Then macro pressure returned. Not a full crash, but tightening. Liquidity costs increased. Speculative valuations softened. Suddenly, that rival fund's aggressive leverage began to show cracks. Redemption pressure increased. Media tone shifted from visionary expansion to overexposed growth strategy. He didn't attack publicly. He waited, because markets do not punish instantly. They expose gradually. When the rival fund's liquidity ratio dipped below safe thresholds, rumors circulated privately. He verified, numbers don't lie. He approached them discreetly, not with hostility, with an offer. Structured capital injection in exchange for preferred equity and governance influence. They rejected him. Pride. Weeks passed. Pressure increased. Redemptions accelerated. Asset sales began. At a discount. He didn't rush. He purchased distressed assets through separate vehicles, selective, strategic, targeting pieces that strengthened his infrastructure. By the time they reconsidered negotiations, he no longer needed majority control. He already owned their most valuable components. That's when the market understood something. He wasn't competing in the same game. Others competed for dominance. He competed for durability. Within 2 years, that rival fund downsized significantly, not destroyed, disciplined by reality, and many of its strongest divisions were now quietly integrated into his ecosystem. He hadn't humiliated them, he had absorbed their strengths, because power is most efficient when it doesn't create enemies unnecessarily. But now regulators were paying closer attention. His growing network touched logistics, finance, private credit, and manufacturing. Individually modest, collectively powerful. Questions began forming in policy rooms. Is concentration forming? Is systemic influence increasing? He anticipated this phase. Before formal inquiries arrived, he voluntarily increased transparency across all holdings. Quarterly stress test disclosures, independent oversight committees, public liquidity reporting beyond requirements. Competitors thought he was weakening his strategic advantage. He understood something deeper. Opacity breeds suspicion. Transparency builds insulation. When regulatory review eventually began, his structure was cleaner than industry averages. Not perfect, but resilient, and resilience is defensible. Meanwhile, internally, he implemented something radical. Every executive was required to present a failure map annually. Not achievements, weak points, liquidity stress scenarios, dependency risks, single-point vulnerabilities. He institutionalized paranoia, not fear-driven, structure-driven, because the laughter that once dismissed him came from comfort, and comfort creates blindness. He would never allow blindness into his system. By the 5th year since that original boardroom humiliation, his portfolio influence extended across sectors in ways invisible to casual observers. He didn't dominate headlines, he controlled flow. And then something poetic happened. At a major financial conference, he was invited to speak. The keynote speaker scheduled before him, one of the men who had laughed that day. Older now, less confident, still polished. When he stepped onto the stage after him, there was no tension in his posture, just calm. He didn't mention the past. He spoke about fragility, about leverage discipline, about liquidity as optionality, about building systems that survive stress. The room listened, because now he had proof. Afterwards, backstage, the man who once smirked approached him quietly. "You were right," he said. It wasn't dramatic, just factual. He nodded. This market teaches everyone eventually. No resentment, no gloating, because revenge is emotional, power is structural, and structure had already shifted. But the true transformation wasn't external, it was internal. Years ago, rejection felt like humiliation. Now he understood it was filtration. The market filters ego first, then filters fragility. What remains builds empires. And this empire was still growing, not loudly, but permanently.
Success becomes dangerous when it stops looking accidental. For years, analysts had described his rise as well-timed. Now they started using a different word: strategic. Strategic implies intent. Intent implies influence. Influence attracts resistance. His portfolio had grown into something complex: logistics arteries feeding manufacturing hubs, private credit pipelines stabilizing mid-sized firms, data infrastructure connecting financial reporting systems across sectors. Individually, nothing monopolistic. Collectively, powerful. Too powerful for some tastes. The first sign wasn't regulatory. It was narrative. An investigative financial magazine ran a feature, "The Quiet Consolidator: How One Investor Expanded During Market Stress." The article wasn't hostile, but it asked dangerous questions. Did he anticipate downturns too precisely? Did he benefit disproportionately from crisis? Was consolidation reducing competition? He read it without emotion. Narratives shape regulation long before laws do. Within months, policy discussions surfaced about crisis acquisition oversight. Industry lobbying intensified. Competitors who once ignored him now grouped together, not publicly against him, but strategically. Because when one player becomes structurally resilient, others feel exposed. He responded differently than expected. He didn't hire aggressive lobbyists. He didn't attack critics. He increased transparency again. Voluntary disclosures expanded. Acquisition terms published in simplified summaries. Employment retention statistics released. Job preservation numbers from his restructurings exceeded industry averages. Data is harder to demonize than silence. Still, pressure mounted. A Senate subcommittee requested testimony on crisis-era consolidation. He accepted immediately. Advisors warned him, "This is political theater." He replied calmly, "Then we bring facts." The hearing room was tense, flashes from cameras, polite hostility masked as inquiry. One senator leaned forward. "Did you profit from economic distress?" "Yes," he answered plainly. Murmurs. But profit came from stabilizing companies that would have otherwise collapsed. Another question. "Did your acquisitions reduce competition?" "No," he replied. "They preserved it." He presented case studies. Firms saved from bankruptcy, jobs retained, debt restructured sustainably. No predatory liquidation, no asset stripping, only disciplined integration. The narrative didn't disappear overnight, but it softened, because facts create friction against exaggeration. Behind the scenes, something more subtle was happening. Large institutions that once dismissed him were now cautious around him. Not because he was loud, because he was stable. Stability during volatility becomes a magnet. Pension funds began allocating capital into his structures. Insurance groups sought co-investment partnerships. Governments invited consultation on liquidity management frameworks. He didn't chase these invitations, he evaluated them structurally. Influence is another form of leverage, and leverage mismanaged becomes fragility. So he created internal firewalls, political engagement separated from capital allocation teams, advisory roles distinct from acquisition divisions, no blending of power streams, because mixing influence types creates hidden risk. Meanwhile, internally, he sensed a new vulnerability: comfort. His companies were no longer fighting to survive, they were performing smoothly. Smooth performance breeds complacency, and complacency precedes collapse. He instituted mandatory stress simulations quarterly, worst-case liquidity drains, credit freezes, regulatory shifts, operational disruptions. Executives protested quietly. We're stable, why simulate disaster? Because disaster doesn't announce itself. Years ago, laughter blinded others. He would not let comfort blind him. Then came a personal test. A former executive, one he had replaced during restructuring, publicly criticized him. Accusations of excessive control, claims of strategic dominance. The media amplified it, not as fact, as controversy. He faced a choice: defend aggressively or let structure speak. He chose silence publicly. Internally, audits confirmed governance compliance. Independent oversight boards reviewed decisions. Transparency documentation released calmly. The noise faded, because noise without evidence decays. But the lesson remained. Scale increases attack surfaces. He adjusted again, decentralized further, reduced personal visibility, shifted branding focus to institutional identity rather than individual leadership. He would not become the single point of narrative attack. Meanwhile, another market contraction brewed quietly. Nothing catastrophic, but enough to test systems. Liquidity tightened regionally. Private credit markets hesitated. Smaller firms panicked. His system activated automatically. Capital buffers deployed. Acquisition filters adjusted. Risk ratios recalculated. No emergency meetings, no chaos, just execution. Observers noticed something remarkable. While others reacted, his ecosystem absorbed shock. Resilience had become embedded culture. And that's when realization struck him deeply. He no longer needed to outmaneuver competitors. He had outlasted their structural weaknesses. The firms that once laughed were now partners, subsidiaries, or disciplined versions of themselves. Not because he crushed them, because he outstructured them. Late one evening, reviewing performance dashboards across sectors, he thought about that original boardroom again. If they had believed him, he might have grown under their umbrella, dependent, limited. Instead, rejection forced sovereignty. Sovereignty forced discipline. Discipline built infrastructure. Infrastructure built leverage. Leverage built quiet dominance. And quiet dominance survives scrutiny better than loud ambition. But even now, one final question remained unresolved. Could the system survive without him? Because empires often collapse not from external attack, but from leadership transition. He had designed resilience against markets, against politics, against media. Now he needed resilience against time. And time defeats everyone eventually. He began preparing the final evolution, succession. Not symbiotic, structural. Because true power isn't buying companies that laughed at you. True power is building something that no longer depends on proving them wrong.
By now, the man who had once been laughed at was no longer measured by his net worth or acquisitions. He was measured by influence without spectacle, legacy without drama, control without noise. The final lesson of his journey wasn't financial, it was architectural. He had built an empire where failure, chaos, and greed bounced off carefully designed systems like water sliding over a stone. Executives who once doubted him now followed protocols that protected firms against volatility they didn't even see. Credit, liquidity, operational stability, human capital, every thread woven into redundancy and foresight. His personal visibility? Minimal, yet his impact? Pervasive. He began mentoring quietly, not for accolades, not for headlines. He trained select individuals on the art of structural leverage, how to see weaknesses in robust systems, how to anticipate stress points before they surface, how to ensure survival during both boom and collapse. Every lesson he imparted carried one invisible rule: never forget the laughter, because it taught him three things. Rejection is filtration, opportunity is disguised as resistance, and control is earned, not asked for. He reflected on the companies he had purchased, some of the same that had once mocked his predictions. Each was now disciplined, stable, integrated, and profitable. They had grown not because he dominated them, but because he had removed unnecessary risk, introduced accountability, and enforced invisible structures that others ignored. By the end of the decade, he had quietly transformed entire sectors. Financial media called it strategic foresight. Analysts called it risk mastery. But he knew the truth. It had begun in that boardroom with laughter and the resolve to act when everyone else doubted him. And then came the moment of ultimate quiet victory. The companies that had laughed at him, many were now under his influence. Some he owned outright. Others were partners in a web of operational dependence. They didn't realize it, but their growth, survival, and profitability were now intertwined with the very man they had once ridiculed. He didn't gloat. He didn't announce. He didn't need to. Power, he had learned, is most efficient when invisible. The press wrote stories about his acquisitions, about market dominance, about extraordinary foresight. The rich and powerful spoke in cautious tones when his name surfaced. Competitors who once dismissed him studied him carefully. Governments asked for insights. Funds sought his guidance. Yet he remained a man who started with nothing. Not because he forgot his past, he remembered every failure, every laugh, every dollar he didn't have, but because he understood something deeper. True wealth is the ability to endure, to structure, to survive, and to allow others to thrive under that architecture. By the time he retired from daily oversight, his empire was autonomous, resilient, diversified, and disciplined. Executives had systems to follow, policies that couldn't be bent by personal whim, and financial stability designed to outlast him. He didn't want to control everything. He wanted everything to run without him, just as smoothly as it had been running in his presence. He looked back once, standing quietly on a balcony of a skyscraper, the city sprawling beneath him. The laughter from years ago echoed faintly, not bitterly, not mockingly, but as a reminder of a journey forged in fire. The man who had been laughed at had bought not only companies, but time, structure, respect, and legacy. And the greatest truth of all? It wasn't the acquisitions, the profits, or even the wealth that defined him. It was the ability to transform rejection into leverage, skepticism into strategy, and failure into an invincible financial weapon. In the end, they laughed. Then he quietly bought their companies. Then he changed history.